Welcome to Market Week in Review for the week ending March 5th, 2021. I'm your host, Laura Bardowick, and joining us today is Senior Quantitative Research Analyst Abe Robeson. Welcome, Abe.
Good morning.
The three stories I was hoping we could touch on today are recent movements in treasuries, then hop over to equities, and then finally touch on key economic data releases this week. So let's go ahead and start from the top. Recently there's been some movement in treasuries, and Powell had some comments on the matter on Thursday. Can you detail these for us and maybe talk a little bit about how investors should be viewing these movements?
Sure. So this week, the U.S. 10-year Treasury yield increased from about 1.4 to nearly 1.6 as of Friday morning. The main reason for this seems to be the U.S. fiscal negotiations. It seems like President Biden is getting around 1.9 trillion in stimulus. There was uncertainty about this number because it's such a large number, and bond rates would naturally rise with that amount of stimulus getting into the economy. Chairman Powell spoke yesterday about this and other things. Powell mentioned that he was concerned that there was persistent tightening in the fiscal conditions. He was dovish in his comments, but he didn't take any action. He gave similar language to what he did previously. They're a long way from their goals, but the lack of any forceful intervention caused the bond markets to go even higher.
So it sounds like we shouldn't be expecting a rate hike anytime soon.
To justify any hikes, they would need stable prices and full employment. And with 10 million out of work still in the U.S., that's definitely not full employment. As far as stable prices go, inflation has been really low, well below the 2% target. Additionally, it's an average inflation target, so they would need to be above 2% for a while, and they're nowhere near that.
So the Fed isn't taking a direction one way or the other. Interest rates have increased. What's been going on with equities?
Equity markets sold off nearly 4% over the week. Technology stocks were hard hit. They are particularly sensitive to interest rates. The NASDAQ is now negative on the year, as higher rates have hurt growth companies. By comparison, value companies have done quite well. Value companies have outperformed growth companies by nearly 10% year to date.
So just looking at time, let's go ahead and switch topics. Can you highlight any key economic data releases this week? Anything investors should really be paying attention to?
Looking globally, the global all industry PMI came out, and it's the highest number it's been since October. That means the global economy is starting to pick up a bit. The US jobs number also came out this morning, and it was stronger than expected, with nearly 380,000 jobs being added, and that's well above consensus. There's still some way to go with 6.2 unemployment there, but it's definitely an improvement. And it's worth noting that jobs number has been volatile recently, and any number within reason would have been cause to expect stronger growth. We're getting positive vaccine news, economies will start opening up, and massive stimulus will keep economies afloat until that happens and help accelerate that recovery thereafter.
Well, thank you, Abe. That's all the time we have for today. And thank you all for joining us as well. We hope to see you next time and have a great week in the meantime.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.